being that this is actually new and something that we're dealing with for the first time right now. Yeah. I actually spent like several hours on this over the past week trying to figure out like what are we actually going to do, and how to not tell clients information that they don't need, which just confuses them. So like, how do you segment your client base? So there's some trickiness around this. I want to make sure we have a discussion around this, you guys, and then I promise we'll get to those other questions as best we can in our hour with Andrea. So pass-through entity tax rules. So Virginia does have a pass-through entity tax, right?
We do. However, there are a couple of exceptions to that tax, and all of my clients fit those exceptions. They're pretty generous. It only applies to non-resident owners, which I don't have any businesses with non-resident owners. I'm pretty fortunate. That's one advantage to working primarily with really small businesses, is they don't have really complicated setups and partners spread throughout the country. So it's only on non-resident owners. And then one of the exceptions to charging that on non-resident owners is if the credit they would get for tax paid to another state is sufficient enough to cover the portion of the Virginia tax liability that is attributable only to that entity's K1, then the entity doesn't have to pay the tax. And that all of my clients fit into that exception. So
gotcha.
So fortunate once again.
Yeah, you guys got a good thing going up there in Virginia. So that and this is kind of what I meant about this particular issue, right? Because like what you just said, Andrea, in terms of California, is the pass-through entity tax means something totally different. Right. In terms of like what you're saying is something that I don't want to pay. Like if I can avoid paying pass-through entity tax, I will.
And you're talking about the one that gets you around the SALT limit, right?
Exactly. Like on the California side. You do not have that. Okay. Interesting. Okay. So California does, you guys, and people that have attended our recent trainings, we kind of broke down the basics of how this works. And I'll post that to the Dream Team and Business Tax Verified recording as well, in case you need more basic info. But basically it's a way around to get around the SALT limitation on Schedule A by electing to pay a tax at the corporation level, and then you get a deduction on the corporate return or on the partnership return, right? And the income never makes it onto your 1040 or the 1040 of the shareholders or partners. So it's quite beneficial. Like the clients that we applied it with have saved, anywhere, Andrea, between $10,000 and $30,000.
That's amazing.
Yeah. So it's like it's quite, because you have people paying 60 something thousand in state income tax and only basically getting no deduction, and now they're getting to not take that 60,000 into the onto the tax return in the first place. So it's very appealing. The problem with it, and it'd be interesting if like Darren or Jake or some of the other folks in California that are looking at this, is they're being unclear, Andrea, about like you have to pay it by 3/15 or else you can't use it.
Right.
And so it's like, then you're in a position as a tax professional, you're like, well, I've got to message this person that you have to pay this tax, this new tax, but it's going to help you, but you weren't expecting it, and it's 30,000.
Yeah.
And it's due by Tuesday.
That is a tough conversation. I've done a lot of CPE around this PTE tax thing, even though it doesn't apply here in Virginia, and it's really fascinating. It's funny because Congress could have fixed all this by just removing the SALT limitation, and then it would have saved literally millions of people a bunch of money and time and energy building this whole workaround. But anyway, what do I know?
I mean, it's kind of like and just the administration of it as well, as like you're trying to run these different spreadsheets. Like it's like that whole beautiful mind, the hang of the calculations. What about this? Then this changes this changes that. So who else is looking at this? And let me kind of big picture for higher income clients that pay more state income tax. This is much more important than for, companies that don't have much net income, or the partners or shareholders are not higher income. Who else is dealing with this or looking at this? Anybody?
Yeah.
Darren?
I got like 40 that I got to get done by Tuesday. So
exactly.
well, and that's where the other one, though, I thought it wasn't going to be an issue because it wasn't beneficial to high income Californians because of the AMT on California.
Yeah, but they changed
the tentative minimum tax. And so 2 weeks ago, and they haven't updated the 540 yet to be able to actually even finish the personal return. And that was the gap on high income people. They would pay 80 grand to get like a $2,000 benefit with the tentative minimum tax, because they only let you take the gap between 7% and 9%. Those are just rough figures. If I'm saying that right, Andy.
And that's what I was talking about trying to run my spreadsheet, Darren.
Yeah,
and the spreadsheet started breaking down.
And they got rid of that. So now and correct me if I'm wrong, but it seems to me that it'll benefit everybody with that tentative minimum tax being gone.
Everybody who
not everybody, but high income.
Yeah, like your type of clientele, like almost everybody, because everybody that's having your state income tax deduction limited on Schedule A,
it'll benefit now.
Yeah, like you'd rather have it not limited, right? And so I think Peggy's question here is like the key thing is like, and I'd be interested to hear, Darren, your thought on this is like, because you want to know like what's due by 3/15. You're like trying to, like Andrea said, trying to prioritize work, right? So do you see for to claim this pass-through entity tax on the 2021 tax returns, do you see that payment needing to go in by Tuesday, or do you see it being more like, hey, it could be paid later, but you'll just pay like interest and penalties? How do you see that?
Yeah, I'm researching it right now as we speak, because I was just assuming that it was due on 3/15. And then that also feeds back in that I don't think they made clarification yet. So I had about 5 clients pay by 12/31 because they were saying that you couldn't accrue the pass-through entity tax. So if they pay now by 3/15, that's actually a deduction that they have to take on the 22 return.
Yeah, but then a credit on the California.
But it's a credit for 2021, return. But they won't get the actual tax benefit till 2022, or basically they'll see it in their estimated during the year this year, basically.
What a mess.
Yeah, and not only that, Andrea, but there's another twist to it as well.
And they didn't. And they didn't. Well, and also they didn't clarify. So a lot of my higher income ones are on accrual basis. And they haven't clarified that if accrual basis could technically still write it off for 2021, even if it's paid in 2022.
I think the rule is that if they didn't clarify it, you can do whatever you want.
Oh, okay.
Is that?
I don't know. How are they going to know?
That's what my dad said, Darren.
I mean, unless you're sitting in front of an auditor, I don't know how. I mean, I guess they could run a thing because there will be a giant PTE payable on the balance sheet. But I don't know. I'm inclined to deduct it for last year.
Yeah, no, totally. So and for people that are kind of maybe haven't looked at as deeply as this. So I've done some research on this, Darren. I was doing this yesterday. So I'm going to post on the recording. I'm going to post the research that I did specifically for California, based on this issue. But there's another little wrinkle here is that the payment of the 2022 pass-through entity tax, you have to pay half of that by June 15th, or else you cannot claim it for 2022. So if you're normally like, and I know a lot of people on this call, including me, are like, you're normally like, okay, let me set this client on extension and then I'll check in like in August or whatever to finish the return, right? But if they don't make that payment, that estimated payment in June, they're going to potentially lose out on both of these. So like I said, I'll post the research, you guys, but definitely some new timing issues related to this.
And just to chime in on that, Andy, is that if by the June one for 2022, that's an estimated. So if they end up not profitable this year, then I don't even know if that gets, I guess it carries through to the state.
But it's weird though, because it's like, it's a set number, right? It's based on your previous year pass-through entity tax, and it'll generate like, this number. And like, my understanding is you have to pay that number if you want to even be able to claim it for 2022.
Yeah.
So,
Yeah,
so in other words, it's all pretty straightforward. This is something that I think if you have higher income clients in a state that has this, I think it's something that a lot of people are planning to kind of check in on later. And what I'm concerned about is that later might be too late. So definitely look at the, look at the extra resources we put in the recording. And sorry, Andrew, I didn't mean to like take us totally off track on that.
Good. That's a crazy, I mean, it's an interesting strategy, and it's nice to have a workaround, and it's unfortunate that they had to make it so confusing. You would think that it would be paid by 3/15 or by the tax return extension due date, like most other, I don't know. It's interesting. Like, how do you even, I can't even wrap my head around how you guys are even calculating this, probably because I don't see it. Like, I don't have any numbers to work with, but
yeah, because the other thing, Andrea, is you're managing it with you're managing that against the personal income tax estimated payments for the state, because it's a state tax credit.
Right.
So it's just like, it's a real mind
What do
bender.
you guys do when you don't also do the owner's taxes, the personal taxes?
Right.
Are you even messing with this if you don't do their personal taxes? Because how would you even know? How would you even have the information you need to figure it out?
Yeah, exactly. You just quit at that point and just walk out.
Just break out a bottle and lock the door. And
well, that's where it's scary. I don't want clients coming back on me and being like, you cost me 30 grand.
Right.
I think that's where that communication piece comes in, right? Is like having like Jake said, an email template or something that's kind of like, this is something to be aware of. This is me dispensing my obligation and my concern for you blaming me for something, and I'm communicating this to you. You may want to look into this further because it could save you a significant amount of money in taxes. And if they want to engage you for consulting around that, then that's kind of a different conversation.